Okay, well, as I promised, I want to get started. I appreciate you putting in the locations. And as I said, please hold the questions till the end. I'm sure some of the stuff I go over will be of interest and might elicit some questions. So what I'm going to do, I'm going to provide a recording, and that'll be available. And I might be able to do it as an automated webinar. I don't know yet. And you're from Naperville? Okay, great, Jay. Okay, well, as you can see, what I wanted to talk about and what I mentioned in the Facebook group is I know there's a lot of interest in how to find, execute, and manage trades. And I know this this group is very mixed. There's some experienced traders and some newer traders. And I don't want to dumb it down too much, but if I generate some questions, we'll have plenty of time at the end, and I'll stay here and handle all the questions. So let's get going. These are some keys that I've put together for trading success, and I'll just buzz through them. You guys can read them, but the things that I found important and what's contributed to some of my success and what conversely contributed to some of my failures in the past. But trading is not for the ego, and you just have, I always say, turn your ego off before you turn on your trading platform, because we always think we know something or we know where the market's going to do. To beat the herd, you must lead the herd. I'm a contrarian trader, as you'll see. I don't typically follow the herd. I'm not a trend trader. We trade by the probabilities, and in most cases that results in us being, I would call us contrarian traders. I would urge you to do, we all search for the next best thing, or the shiny, bright object syndrome, but stay away from searching for the holy grail. And there's just no holy grail in trading. It's all learning a method that works for you, works for your personality, works for your risk tolerance, and executing that methodology. One thing that people, I think, get out of whack, and I learned the hard way, is your reward must be congruent with your risk. And very simply, that means an analogy that I like to use is, if we were flipping a coin, I think everyone here would acknowledge that it's a 50-50 shot. Whether you flip the coin, it comes up heads or tails, 50-50 shot. Not that you can't have 4 or 5 or 10 heads in a row or 10 tails in a row, but I think if you set up and you're flipping with your friend, and you say, okay, every time it comes up heads, I'll give you $2, and every time it comes up tails, you give me $1. That would be your reward. Will certainly not be congruent with your risk, because if you flip this coin 500 times, you're probably going to lose about 250 times, and your net loss is going to be about $250. So that's kind of what I mean by reward must be congruent with risk. I am a firm believer that every trade or trade adjustment should in some way improve the cost basis. We can delve into that a little bit later. If you're familiar with covered calls, people like to buy stocks. I say always sell calls against it to improve your cost basis. When we do spread trades, we're always improving our basis. And of course, when we do adjustments, we're attempting to take in credit and improve our cost basis. Trust the math. If you've read any of my books, you see me talk about that all the time, because over the long haul, the math does not lie. The probabilities will work. Not that they work 100% of the time. There wouldn't be a market, but as in the coin flip analogy, if we flip that coin, we flip it 10 times, there may be 10 heads. Pretty remote chance that would happen. But if we flip it about 1,000 times, you're going to start getting closer and closer and closer to 500 heads and 500 tails. In our world, the secret sauce is implied volatility rank. That's a little different than implied volatility percentile. I used to use those terms interchangeably because this is all I've learned through the Tasty Trade process and listening to those guys, and they kind of use them interchangeably early on, but there is a definite distinction between the implied volatility rank and implied volatility percentile. I like to use implied volatility rank, and I think you'd be just as successful using implied volatility percentile, but be consistent. This is a mantra of Tasty Trade, as you know. It's mine. Trade small size and trade a large number of occurrences. I would much rather you trade one contract
10 different positions than 10 contracts on one position. And that's all relative. I have traders in our gold level group that trade 10 lots, and if that's a comfortable size for them, then that's fine. But I think you want to keep that consistent in your trade size, and you want to spread that over a large number of occurrences, because as Murphy's laws, you think you finally know something and you do 10 contracts on this one, and that's the one that goes against you. Proper risk management, I think that goes without saying. There's ways that we really manage our risk. And then personal preparation and commitment. I think you have to treat this like a business and not a hobby. I know a lot of people treat it as a hobby, but I think you have to treat it like a business, and ultimately prove the concept to yourself. I keep pretty detailed records of all my trades for the benefit of the members and for my benefit. I like to know, what works. Of course, we're at the end of the year now. We'll see what worked and what didn't work for 2020. That's just a little bit of an introduction to what I think are keys to trading success. I'd tell you a few things about me. I've been actively trading stocks since 1990. Started trading futures and options in 2005. I'm ashamed to say, but it's true. I spent six figures on gurus and indicators and black boxes and programs and all that stuff. And I wish I had that money back to trade and invest the way that I do today, because there is no holy grail, and a lot of that stuff works till it doesn't work. And like I said, I wish I had that money back. I'm kind of ashamed to say that I spent that much, but I know a lot of us are always chasing that bright, shiny object. So the Bear Stearns debacle, if you've read either of my books here and some of my articles and posts, that I had a real bad situation in Bear Stearns. If you guys of course, you remember they ultimately went out of business, but they encouraged me to turn over my Roth IRA. I had paid the taxes to convert it to a Roth back in 2000 and about 2000, and they put it into some fly-by-night. It was my retirement. My total retirement was $250,000, and they lost all but $13,000. So from that point on, I said nobody will ever. If I'm fortunate enough to accumulate some funds again, nobody will ever touch my money again. And my mission in life, I'm an old guy, but I'm not any guru or anything, but my mission in life is that everybody become a self-directed investor. Well, and I've been trading online and mentoring in trade rooms since 2014. I was with Bill and the guys at Traders Den 24, and I may relaunch that for the future side of the business. But that's just a little bit about me. Don't want to bore you. Now, I want to talk a little bit how we do what we do. First of all, if you've heard of Tasty Trade, the Tasty Trade Financial Network, I've been listening to them till the day since the day they opened. I subscribed. There used to be a monthly subscription fee. I believe it was monthly, but that we paid, and you've got a badge or some I guess dog tags they're called, and so that goes way back. So I've been with them listening to them since almost day one. Listening and doing the way and learning how to, not that we do things exactly the same, and because you kind of find your own niche or nuances over time, but I still listen to them, a couple of their segments every day, and I'm the first to admit that I drink the Tasty Trade Kool-Aid. I have a lot of respect for what they do, and they've just spent millions of dollars on research, and that's just something that most people can't do. Obviously, I cannot, and I'm sure most of you can't either. So I rely a lot on their research and what we do, and it's changing a little bit over time, and that's good. I mean, some of the things that we'll talk about, I've noticed some slight changes over time, but that's what the research has shown, and just fabulous research. What I want to say about the way we trade, I don't have any proprietary indicators. I don't have any proprietary setups. There's no black magic. There's no black boxes. There's, the hush hush type of things, and join my program for $5,000, and you're going to take $2,000 and turn it into $1 million in 2 weeks. So, none of that. Everything is based strictly on probabilities. The majority of our trades, and I'll show you a list of what we've done this year, the majority of our trades are short premium, short volatility trades. And if that's confusing, we'll touch on that a little bit, and of course, be able to answer your questions on that at the end. And implied volatility, if you are a short premium trader like we are, implied volatility contraction to the mean and theta decay are quantifiable edges, and we'll talk a little bit more about that. But most of the trades that we put on, and you'll see that our sweet spot's like 45 days to expiration, but we put on they're positive theta decay, they're positive theta trades, so every day they're decaying a little bit, provided that volatility does not expand or price doesn't materially change. And then we know that price is not necessarily revert to the mean, but we know for sure that implied volatility will over time, not always in our time frame when we need it to, but it will over time revert to the mean. And we'll get into that a little bit with the implied volatility rank. I just want to touch on, I don't want to send anybody screaming, but I just want to touch a little bit on standard deviation and expected move, because that's what pays our bills. That's the way we position our trades. Most of as you'll see here, most of the trades that we do and I do are in that 70% probability of profit range. If you look at that graph on the right side, that's a, I'm sure you've all seen it. It's a standard deviation log normal or normal distribution curve. We're primarily dealing in that middle white spot, where about 70% of the time we're doing trades just barely outside that or at those two limits. And we know that about 70% of the time that price will stay within that range. And if we go to a 2 standard deviation move, like we do oftentimes in earnings trades, we're getting up to about 95% of the time price will stay in there. And we could touch on that a little bit later. But I think the important thing to do here is some people like a higher winning rate, and some people like want to maybe have a lower winning rate and take in more premium. I just kind of like to work in that 2/3, 1/3. I'm risking $2 to make $1. So if I put on a spread trade, I'm risking $2 to make $1. So let's just say it's, for conversation's sake, it's a $3 wide credit spread of some sort, or an iron condor. If I collect $1, my maximum loss is going to be $2. And you might think that's really crazy to, why would you do that? You've always been told, your risk reward should be positive. Well, if you're a premium seller and a volatility seller, that's not going to be the case. Now, you can structure yourself to where if you want a higher win rate, you can go further out. You could be in that 1.5 standard deviations or 2 or whatever. But what I would encourage you to do is do the same thing over and over and over again. You'll take in less premium. You'll have a higher winning percentages. I've just found that kind of in this 1 standard deviation and then doing credit spreads where I'm risking 2 to make 1 are all kind of in that 70%, 75% range, 67% range. And what we'll talk about a little bit later is by managing these winners early, contrary to what we've all been taught, let your winners run and manage your losers, you'll find that win rate percentage will get up in the mid 70s and approach 80%. And like it says here, in defined risk trades like iron condors, credit spreads, etc., I want to collect about 1/3 of the width of the strike. And if you're using the high liquid, tight bid-ask spread stocks and ETFs like we trade, it's the 2/3, 1/3 that gives you a 67% probability of profit. So, but that does increase if you manage your winners early. And then on undefined risk trades, most of the trades we take are in that 1 standard deviation range. That would kind of be in that white area that you see there, where it says 68.3. It's rounded off to 70%. So we know if we take a trade on the two sides of that about 70% of the time price is going to stay within there, and that would be a winning trade. And of course, once you put the trade on, it's a positive theta trade, and every day you're going to gain whatever that theta is. And I'll show you that on the platform, maybe give you a little better idea. Now, what I pride myself in, and what's really turned things around for me, is being very mechanical. First of all, starting out with trading small size. The trades that I post in the Facebook group, the trades that I do in the live room, I have about a $25,000 account. I only do 1 contract. But everything that I do is very mechanical, and you can use change. You should skew your contract size to your account size, but everything that I do that you'll see me do is one contract. I have some other accounts that I manage that I do more contracts than that, but I do one contract for a couple reasons. I want this thing to be realistic. You don't have to have 25,000 to participate in the trades, but this will kind of give you a sense. If you have 25,000, you kind of get around that. You get around that pattern day trader thing. We really don't have to deal with that much unless we make a mistake, because rarely do we put a trade on and take it off the same day. That because we're waiting for the theta decay and the volatility to come out of it. So I prefer to be very mechanical. If I keep my trade size small, there's not one trade, I don't worry about it, and that goes against me a great deal. I just know that I can manage it to the best of my ability and just keep very mechanical is the way I enter the trade, exit the trade, and manage the trade. So to that point, I no longer use any technical analysis or fundamental analysis. And I think 99% of the people do that, and probably 99% of the attendees here today rely on technical analysis or fundamental analysis. I don't use any of it. I don't even use charts. I'll take a look at a chart to see if, and I'll show you an example on the platform. I'll take a look at the chart to see if it's gone way up or way down, or is it kind of just hanging around the middle. It just gives me a little bit of an idea of what kind of strategy that I might put. I don't use any scanners to find potential trades. I've looked at some different scanners. I'm actually evaluating one now, and if he can make a few changes, it may have some merit for us. But I don't use scanners because I start out with a database of stocks, which I'll share with you, and I've already pre-screened those to meet my criteria. I don't use any indicator packages to find potential trades. Everything's right on the option chain. I'm looking at the open interest, and I'm looking at the deltas, or the percent in the money, percent out of the money, whichever column you like to look at. Don't use any special software to find potential trade candidates. Now, you will see in the room, I typically have the futures charts projected. I do trade futures, and I enjoy trading futures. I think they're a great engagement tool, and I also think I use them to balance my deltas and how I control my deltas in my option portfolio account. But and for trading futures, I use a package called Dimension Trader software, but I don't use any software to find, manage, or otherwise do anything with my option trades. We do use implied volatility rank to find potential trade candidates. I use the option chain to provide the framework for all our trades. We manage winning trades at targeted profit levels, which is key, managing trades early. So many of us that have traded options always wanting to put the trades on and wait to expiration, and it's so darn tempting to do that. But if you spend any time with us in the group, you'll see that I'm pretty adverse to waiting till for something to expire. And I know it's very attractive to put a trade on, a weekly trade, and then let it expire to zero, but I've eaten too many fingernails waiting that last day or two, waiting for the thing to expire, and it's just not worth it. I've got too many stories where, I thought I knew something. I'll wait one more day, and the one I mentioned to someone in the room today that it still sticks in my craw is AOL. They were, the trade was a strangle or something. It was right in the middle, and I said, I'll just wait till tomorrow and take it off. Well, then I think Verizon announced they're going to buy him. I mean, it's like a $500, $100 loser on one contract just overnight. So I'm very mechanical about managing winners, and we'll talk about at what point I do that. And we do adjust trades. Some people prefer not to adjust trades, but we adjust trades when it's necessary to extend duration. Now, this might sound like a bunch of gobbledygook and really hard, but it's really pretty easy. So let me show you. This is how I trade, or how we trade, and how I trade in the gold level group, and how I do all my trades. And this is what I think makes it very easy, unemotional, mechanical. It doesn't take very much time. I put a little flow chart on the side, but let me kind of walk you through it. So first and foremost, I develop a list of pre-vetted stocks and ETFs. I just updated mine for 2020, but frankly, they don't change that much. For this year, I did add a number, usually around 200. I'm around 270 this year. And what that does is if you remember, I said earlier, I don't scan for stocks. I don't, listen to someone on TV. I won't name names or all this stuff. Maybe if they mention a stock, I'll take a look and see if it meets my criteria, but I don't listen to anyone to make my trading decisions. It's all by myself. And what I do with having a pre-vetted list of stocks, you can put a lot of that stuff out of your mind as far as, let's look at this stock. And I get questions on that all the time. What about this XYZ stock? And I'll take a look at it, but if it doesn't have the large open interest and the tight bid-ask spreads, I'm not really interested. Doesn't mean I won't add it to the list if it is, because there are trades that leave our list every year and come on our list. This year, obviously Zoom was big time in play. Didn't have that on the list last year. There's, of course, Tesla a couple of years ago, not ever heard of, but and stock like Crowdsource, there's some different ones. DocuSigns come on the last couple of years. So there are some that I'll call, they come into play. In other words, now they're getting some activity. They got a decent amount of volume. The spreads aren't too bad. So we can, those are on our list, and so we'll modify that from year over year, or during the course of the year. If something comes public and all of a sudden comes into play, like Facebook did, and obviously that one's one of the ones in play. So they do. There is some additions and subtractions through the course of the year. So the first thing you do, if you can take a list to say, and in your mind that out of these 200 symbols or 250 symbols or 70 symbols, I think this year I traded 122 different symbols to date. Out of that list, that you don't have to do scanners. You don't have to look for all kinds of arbitrage or all kinds of different things. That list meets your qualifications. Now, there will be times when some kind of news event happens or a binary event, and those spreads will widen, and we will elect not to put a trade on at that instant. But if you could just simplify your life by saying, okay, out of these 200 symbols, I'm going to be able to find enough trades. So that to me is extremely important. Then what I do is I take this list, and I'll show you how I do that. I sort the list by implied volatility rank, and this is something that's changed. And I talked about the research from Tasty Trade. Years ago, we drew the line in the sand at an IV rank of 50. So if it was over 50 or higher, we sold premium. If it was under 20, 25, as I recall, those would be long premium plays. Well, that's changed due to the research. Now, what they've found is that, of course, the higher the implied volatility is on a stock, the higher the options are going to be, so the more premium you're going to collect. So if the implied volatility rank on a particular stock is 80, and you're doing a one standard deviation strangle, and it's a $100 stock, you're going to get a lot more premium for that than if you're going to do one that's 30, that's $100 stocks. But and that may not make a whole lot of sense to you. But they found that the winning percentages stay the same. You just don't get nearly as much premium. So instead of maybe selling a strangle and getting $2, we get $1.25 or something like that. But the win, everything else we do is the same. We put it on, we manage it, et cetera, et cetera. And then when you get below 25, and I fudge on this a little bit, depending on the underlying, but you get much below 20, 25, now you're looking to use long volatility, your long strategies that are long in premium, or you're buying premium, or like I said, it's not etched in stone, but those are give you some parameters to work from. Our expiration cycle is pretty simple. The sweet spot, according to the research, is 45 days to expiration. Obviously, every cycle that we're in only has one of those 45 days. So we're a little flexible on that. We are always looking at the 45. When we get around that 45 days to expiration time frame, we're looking to for more trades. But if it's fifth, there's 4 cycles a year that have 5 weeks in them, so sometimes that gets stretched out a little bit. We'll go to 50 or 55 days, and I really won't enter a trade once it gets down to 28 days left in the cycle, because it just doesn't fit my criteria. The only exception would be earnings trades, which we'll also talk about. We do a lot of earnings trades in the gold level group. The other thing you want to check for, always be checking for binary events in the cycle you're trading. So if you're going to be doing trades now, we're now trading in the February expiration cycle. If you're going to do trades in that cycle, you want to see if earnings are in that cycle. You kind of want to stay away from that. That's the biggest binary event that we deal with. If there is news and there's an upcoming stock split, or even a smaller extent, there's a dividend coming up, you want to kind of have be aware of that, because that will have an impact on price. Sometimes the dividend isn't big enough to make a difference, but any binary event, anything that is out there in the public that's known, you want to make sure that you're not trading in that cycle. The other thing that I like to do, when I mentioned earlier I was a contrarian trader, I trade into strength. That doesn't mean that everything I do is long. So if a stock really tanks today, I'll be looking to sell a put on it or a put spread, and I'll show you a little bit about that. But and if a stock has gone crazy, like last week, it hasn't worked so far, or 2 weeks ago, I think I sold a call spread on Disney, and I think one of them worked, one of them still in the money. But when it spikes up, I'm looking to sell either stock or sell naked calls or sell call spreads, something that is bearish, and vice versa. And when you go through this process, be aware that the only time you really control your risk is when you execute the trade. So you heard me say earlier, I like to stay around that 70% probability. So if I'm doing all these steps, which may seem like they take a long time, and I guarantee I can do a trade in 30 seconds or less, but if you keep all that consistent and you're not making all these exceptions and everything, you'll know that you're controlling your risk at trade entry, and you're about what your probability of profit is. But that, once we hit the button and we send and we get filled back, it's up to the market. We know that we have the odds in our favor for both volatility contraction and theta decay, but it's really up to the market. We can't control. We can control risk by doing adding some wings or something like that. But basically, that's when we control risk at entry. And I'll repeat it again, to be consistent in the premium you collect. Like I said earlier, define risk trades, iron condors. Iron flies a little different. Iron condors, credit spreads, put credit spreads, those type of trades. I want to collect a third of the width of strike. And if I'm doing high implied volatility stocks and they have tight bid-ask spreads and a lot of volume, they're on our list, then I know that if I collect a third of the width of the strike, the probability of profits around that 67%, that 2/3, 1/3. Now, undefined risk, I will trades, and probably 25% of the trades that I do are strangles, which you're short a call out of the money, you're short a put out of the money. I'm consistent with probability, so I'm going to usually be selling about a 1 standard deviation strangle, maybe a 20 delta strangle or something like that. But again, keep that consistent. That's the important thing, because over the time, the math will work if you stay consistent with how you the trades, the criteria you use, how you select it, the premium you take in, and then how you manage it. Now, what I mentioned, managing the trade mechanically, those that are in the gold group that are here today will attest to that. My target profit is 50%. So if I sell a strangle today, which I attempted to do on GDXJ, but if I sell a strangle, and let's just say, to make the math easy, I collect $2 for that strangle, and it's a 1 standard deviation strangle, I know I've got about a 70% chance of that, of the price staying within those 2 strikes, the short call and the short put. When it gets down to $1, I can buy it back. I buy it back. I take 50%, and you can fudge that a little bit, a few pennies one way or the other. So I often all often on Friday if I hit a 50% target, and it's not even being threatened. I may wait till Monday just to get a couple more days of theta decay out of it. But my rule, my criteria is I want to is 50% of the premium collected. Now I have a personal exception, and I'm not advocating as you do or do not. But I say if in 7 days or less I can make 25% or more, I will exit that trade, put a new trade on, or maybe I'll even put the same symbol on maybe the next cycle or something. But and what I mean by that, let's go back again to I sell this strangle for $2, and in a few days I can buy it back for $1.50, which would be 25%. I'm making $50. I'm leaving $150 or $1.50, $150 per one lot on the table, but I take that off and I redeploy the capital, and I do that. That's what I call my 7-day exception. I don't know if other traders follow that, but I like to do that because I want you to think of it this way. And you'll say, well, why would you leave all that profit on the table? Well, let's just say we put a trade on and there's 45 days to expiration. Now we know, and we collect $2. Let's give the same example. We collect $2, and we put a good to cancel order to buy this thing back for $1 or whatever. If you want to cover the commission, 98 cents or whatever. But let's just say we're selling it for $2. We buy it back. We're going to buy it back for $1 and going to make $1 or $100 per one lot on the trade. So if I've got 45 days to go, I know I'm going to typically manage these at 21 days. So obviously that's 24 days. Now, if this thing comes in 25% in a matter of a couple of days, do I really want to wait another 20 or 25 days where it could go against me for that? In this $2 example, I collected $2. I'll take my $50 profit now and redeploy the capital rather than waiting for another 20 days or 25 days, and maybe even the trade even could go against me in that time. So that's the reason. Again, a lot of people just stick to a defined profit target, but I've over the years I've found that there's often, not oftentimes, but there's a lot of times that we'll get lucky. A trade will come in and we can take 25% off in a matter of a day or two. Now, I usually kind of temper that a little bit. I kind of want it to be $40 or $50, something meaningful. I mean, if I sell a spread for $1, which would be the least I would sell, a strangle for $1, at least I probably wouldn't take it off for 25 cents, but you could certainly do that. But I'd like to give a little bit more money, but most of the strangles we sell are going to be more than $1. Now, I manage these trades. This is what makes it so mechanical and is simple. Once you get your head around it, is I manage it mechanically at 21 days. Again, relying on the Tasty Trade research. They've done a fabulous job of their research, and they found that if you're familiar with the theta decay curve, how it starts falling off in the last couple of weeks. So at 21 days, if I haven't, my first rules, obviously I want my profit. I'm hoping or hopeful that my profit target of 50% is going to be achieved. And that happens on the average of about 19 or 20 days most of the time. But it doesn't always happen, of course. So at 21 days, if I haven't reached my 50%, I haven't exited this trade previously because it's reached its 50% profit or the 25% profit, obviously. But now we're down to 21 days. If I can take that trade off for any profit, doesn't have to be 50% anymore or 25%. It could be 2%, 10%, 12%, any profit, or even as low as a scratch, which is a break even, I'll exit the trade. If I'm now in the January cycle, we just passed the 21 days last Friday. I am doing that. Late last week and early this week, I'll be exiting trades that I can take off for a profit or a scratch. Not waiting. I'll put the trade on for February, maybe with the same symbol if it has the necessary implied volatility. Now, if the trade can't be exited, I can't get out of this trade for zero or any profit whatsoever, I'm going to roll that trade to extend, unless my bias has changed, which rarely does, but I'm going to roll this trade to extend duration. So I'm going to take this strangle and I'm going to roll it out, maybe adjust the strikes a little bit, but if I can't exit it, I'm going to roll it out and to extend duration. Now I'll give myself another 30 days or 40 days to maybe the trade to work in my favor. And I'll only roll that trade regardless if it's a defined risk trade like an iron condor or a credit spread. I'm only going to roll that trade for a credit or zero. That's it. I'm not going to put more capital in the trade to roll it out. If it's 3 or 4 cents on a $10 wide, that would be exception. But basically, I do not want to put good money after or throw good money after bad. So I don't add capital or risk to the trade. So if I got a trade now that I've put on, and like my Disney trade, let's talk about that one. I sold the 175, 170, and I sold it for about $1.70, a third of the width of the strike. And now it's through my long strike. I sit on my hands. I don't do anything. I may sell another put spread against it or something, but it's just a little more advanced. So I don't go into that today. But I really do nothing. SOH, I sit on my hands. And some people will employ a max loss or 2 times the premium collected, etc. I don't. But like I said, if you want to employ some type of stop loss, if you're more comfortable doing that, you want to do that all the time. I just don't want to be. For me, and what the questions that I get, and that especially with the newer traders, is we got a week to go. And this trade's a total loser. I collected $1.70. I'm going to lose $3.30. Now I can take this off on Monday or Tuesday and only lose, $3.10, $310. I don't do it because some people are comfortable doing that to save 10 or 20 bucks. I would much rather lose the extra 10 or 20 or $30 or whatever the case may be than something happens and markets move, and on Friday this thing blows and I could have scratched the trade or even worse, made a profit. So that's the way I do it, and I do it consistently. I just don't exit trades early, and if the trade's gone against me, I accepted the risk. Like I said on one of the previous slides, I controlled the risk at entry. I knew what it was, and this mostly applies to defined risk trades, because we can always adjust strangles and too advanced for today, but we get into inverting strangles and things like that. So most of what I'm saying here applies to iron condors and credit spreads, butterflies, things like that just haven't worked out. And that, again, on that stop loss, I think it's optional. To me, it's not even an option, but some people like to do that. And I'll tell you the reason that I don't is because of what I said. The way when you get that last week and you've got high gamma risk, because the change in volatility can both go against you or go in your favor very, very quickly. If I did a $5 wide credit spread and I collect $1.70 and I'm risking $3.30, if I'm going to do it 2 times the premium stop loss, 2 times $1.70 is $3.40. So to me, it's about a push. And like I said, most of the time, if on strangles and undefined risk trades, we're much more aggressive to manage those. So most of this applies to the defined risk, the iron condors and the credit spreads. Now, I've got 32 strategies. You saw that book I did, the 32 most common strategies that I've got that. These represent the ones that we do the 99.5% of the time we're selling premium. I've got bullish strategies, neutral strategies, and bearish strategies. The color coding is something I came up with years ago. The green ones are what I call trade level 1 trades, that any new trader should be very comfortable doing any of those trades because they're defined risk trades. You're not taking that unlimited risk like you are with a strangle or a straddle or something like that. So the green are what I call trade level 1, and I kind of separated those. And then the yellow are trade level 2. Again, with any kind of familiarity and a little bit of experience, you should be comfortable doing most of those. They're the Jade Lizard's one of the girls at Tasty Trade, and that's got a naked put component. So that would be, to me, that's much more comfortable for a new trader that sells naked short puts. They should be fine with that trade. So That could really conceivably be a green one, but those are yellow ones. And then the red ones are the undefined risk. They're the more advanced trades. Sometimes they're not for the faint of heart, but those are the trades. And in these strategies that you see on this page, we do a few directional trades. We do some covered calls and some they call them poor man's covered calls, things like that. But the majority of our trades are these going to be these premium selling trades. Now, that wraps up what I wanted to go over today, because I wanted to leave plenty. It's 4:41. I said I'd be done by 4:50, and I wanted to leave you guys plenty of time to ask me questions. That's what I'm here for. And I'll mention a little bit about the gold level membership we have, because you've seen me talk about that in the Facebook group. I've got a small group. There's a and I'm going to release some resources here for you in just a second. But there's I do have a video on it, and it's really pretty simple. I mean, it's a group. I have a private Skype chat, and I've got and we have a live trading room. I use the trading room. I'm typically projecting the futures trades, because if I'm going to do a trade on Apple, I kind of want to know what the NQ is doing, because the Apple's part of and they're also part of the Dow now and everything. But I kind of want to know what they're doing. It might give me just a little bit of an edge. And then I do like to trade futures. So, and what I do is I post all my trades, exits and adjustments. I post them real time right in the Skype chat. If you are at work or different time zone, you can get Skype on your phone. If at some point in time we may do a different application, but Skype worked out very well. So we've got a private Skype group. I've got a live trading room. I'm around most of the day. I think this is what I differentiate myself, and I think anybody will tell you that I'm around most of the day to ask questions. We're normally kind of busy, but from about 9:30 to 11 when we're trying to find new trades, adjust old trades, exit trades. But as questions come in, I'm there to answer them. I prefer to, if you have access to the live room, I can answer them because I can talk a lot faster than I can type. I'm not the greatest typer in the world. But and the other thing that I touched on is we do a lot of earnings trades. All the parameters are the same, pretty much what you talked about. We'll do maybe a little shorter time frame. And we like to do earnings trades. What we do with earnings trades, most of our trades are going to be neutral. I can show you some of that, but I'll show the report, the trade log. But most of our trades are going to be neutral for earnings trades. But those are trades that kind of fuel our instant gratification. I mean, our basic trade we're putting on with 45 days to go. We're hoping to exit it. It's probably on average about 19 or 20 days. We're going to manage it when there's only 21 days left in the trade. And those are our regular trades. Earnings trades we like to put on and hopefully take them off the next morning. And I think you've seen me post some of that in there, and I'm going to share that spreadsheet with you. But so it's a small group, and you'll if you're an active trader or want to become an active trader, you would, I think, get a lot of benefit. It's only $99 a month. There's no contract. You could come, you can stop anytime you want. I do want to show you a couple of things. I want to release. Yeah. Okay. Yeah, John, thank you for the question. I'll get to that in just a second. I want to see if I know what I'm doing here as far as this. Okay. I just opened there's a trader resource page that you should be able to download. You can, I have, if there's an interest in here's my database I just finished doing for 2021. I've got that. I'll make that available to you if you like it. I can release that. There's 200 and let's see, I think we started on 2. So there's 269 symbols, and most of them are going to be pretty consistent. So if I've got a PDF of that. I can release that. And for the members, I've got an Excel form if you want to just download it. because I do want to show you something about the platform here. So here's a little brief. There's a little brief PDF on the trade selection. So I'll go ahead and I'll tell you what. I'll put that database up. You may or may not have interest in that. And I made the slides in a PDF, so I'll put those up too. I mean, obviously have to waste your time, but you may find some interest to that. I do want to show you a couple of things, a couple tools that I use. This is when I talked earlier, you can do this on your platform. I trade on the Tastyworks platform. I trade on the Thinkorswim platform. So I'm fairly proficient on both of those. Been doing obviously Thinkorswim for a lot longer. But you can nowadays, they've got a lot of this stuff right on the platform. I'm going to minimize this here. But what I like to do is this is my data. This is the new database with 269 symbols on it, and includes this includes ETFs, which of course don't have earnings. So I can take this in the morning or the end of the day, whenever, and I can go and I can just sort this by IV rank. Okay, now Snow's a new one I just added. It doesn't even have an IV rank yet because it hasn't been around a year. But these ones, the ones that you see in orange, anything kind of over 25, that just kind of obviously by sorting them in order, you know that. But the ones in orange kind of give me a little heads up. So those are the ones I'd be looking at for potential short premium trades. Down on the other end of the spectrum, anything kind of under, I said 25. I kind of hedge on that a little bit. So anything's kind of really under 20, 15, these that are in green, which right now is not particularly volatile time. So you can see there's a lot more that are in green. Those I would be looking to do potentially long trades. So that's just really easy for me. And then kind of the white, kind of the mushy spot in the middle, Apple, I rarely would buy premium on that unless I bought stock and sold calls. But even though at 22.6, I'd probably go ahead and do a trade on that one if I didn't have it already in my portfolio. And the other thing I wanted to mention is pay particular attention to correlation. And what I've done in these is I've got a thing where I can correlate these to the S&P, SPX. So I made a huge mistake years ago when I was, it's been long. When I first started doing the probability-based trading, I was doing all these trades and I was doing what I'm showing you, and I sorted them, and I'm not paying attention. All of a sudden, I end up with almost all my trades were in the energy sector. That didn't turn out well. So you want to be careful when you're doing trades. This would be too advanced for today, but when you get to the point where not only do you want to watch correlations, you want to begin to watch your deltas. And if you have a short bias, I like to have short deltas on. I'll show you that on the platform, but I like to have a little bit of short delta to kind of a hedge against the portfolio. But whether your bias is long or short, but you want to do trade once you get your portfolio set up. You want to do trades that fit, that are congruent with your overall portfolio. So you don't want to find yourself all of a sudden you got 500 or 600 short deltas or 500 or 600 long deltas. You want to you hear about delta neutral. And when you're trading the kind of trades that we do, where we're selling premium and we're trying to stay in the middle of that standard deviation, we're leaning more to delta neutral trades. So now what happens is, if the market moves one way or the other strongly, like if you've got, like me, I've got, say, a couple hundred short deltas on now in this $25,000 account. If that market drops, I'll lose all those short deltas. So that if you have it in stock, those are static deltas. And again, I'm getting a little too advanced for today, but that's something that we work on and I keep an eye on all the time. So correlation is important. You don't want to have all your eggs in one basket. I can also go in here. The only thing I can't get from a data source is the earnings. So I have to manually update these all the time, and I stack this has just been updated recently, and these will change throughout the course when we get involved in earnings, which start around the 7th of January again, and then just before market. So, and then dividends, I mentioned that can have a little bit of an effect. So oftentimes I'll look and I'll say, where these haven't even come up with their new dividend date yet, because this is all pulled from Thinkorswim. I use their API to do that. So now we're getting into some. So now I start looking. Okay, American Express has got a dividend. I got a position on that. I got to be careful of those. So find that helpful. So this is a tool that the API I pulled the live data in from Thinkorswim. Tastyworks is supposed to at some point provided a API, but to my knowledge they have not as yet. So that's another little tool. Let me get the chat back on here, and I will let's see if there's anything. I want to check something here, and then I want to get to your questions. This is another tool that I have. It's called the Option Strategy Matrix. I think most of us already been trading for a while. You know this, but what I did, I took the 32 strategies. The green ones are the trade level 1, trade level 2, trade level 3. And then if you're bullish, let's just say you've got a lot of short deltas and you want to look for bullish trades, you can just click on and sort it by bullish, bearish, or neutral and say, okay, well, here's the ones that are bullish. Then the outlook on volatility, you can sort by that. The profit potential, whether they're limited, defined risk or undefined, loss potential, etc. So that's a little tool that I can make available. It's something I put together a few years ago. Let's see if I got anything else there I wanted to share with you. I do want to share. I want to talk about earnings trades because I see there is. Okay, let me show you the earnings trades because this is a lot. I've only done 49 this quarter. The quarter from October 1st to 12/31, which obviously we're at 12/31. Now here's the trade detail. These are all one lot trades. This is a spreadsheet that some of my members, nothing special. It's just an Excel spreadsheet that I've developed over the years, and I input all my data religiously on this, and I can I do it for. I want to show you. It'll be easier to explain on the smaller one. Let me find. Okay, I'm going to bring this down. Here's the trade detail for the whole year, and you can see that I do it by the date I've done 407 this year. It's a little on the light side for me. And this is the overall trade log that I keep, but I also keep what I was going to show you is the trades that I've got posted on here are also in my overall log, not vice versa. So every quarter I keep separate statistics on my earnings trades. So we just finished Q3. That's obviously on the calendar. It's Q4, but it's Q3 earnings. It's the period from October. From July 1st to October to September 30th. Now we'll start working on the fourth quarter earnings. So what I do on this, let me go over it briefly, and then I can get to John's question. Obviously the date started about the 12th. This time we got some coming up next week on the 7th. I sold it. It was a wide strangle, which is a wide arm condor, which is really a synthetic strangle. I sold the thing. I collected $95 after some adjustments. I closed it for $58. That one only had a profit of $36, but that's that's a one lot. It only put up $294 to do that. So the return was 12.5%. And you can see, you're going to say, well, he has no losers here. Well, there's two ways to do earnings trades. I choose to do them if I can manage them. If they come out of most of the trades were taken off in a day or two. We did a couple here. that was Lennar Homes. Now I was in the thing 12 days, but most of the people got out of it quickly. I had some stuff that came up. Nike trade. I kept that over the weekend, so it was in the 4 trades. We made $140 on that one. And these again are all one lots. This is the initial capital it takes to put the trade on, and then and right now in this quarter, just from 10/1 to 12/30, we've done 49, we've closed 45, and we've got 4 open. In the 4 are my PIA trades, pain in the you-know-what trades. I've got, and I'll talk to you about those because in what could potentially happen. Snap came in a lot today. I've collected almost $475 in profit. If I could probably take that one off now for a couple $100-point loser, but I'm going to continue to manage it. Qualcomm is going to be a small profit. It just came in again today. I was looking at that one. The 2 that are really Best Buy, that's a couple $100 loser now, but right now I'm just short the put side. I'm hoping to milk that thing. And then finally, this SFX has been a real, you know what? So FXS and Snap is the other one. There's a Snap. Yeah, this Snap trade and this SFX trade. Finally today, they've had us in blue jeans and gym shoes. Those are finally coming in. So this time I did 49 trades. I won't be doing any more earnings trades for the end of the year. There aren't any more. And I'll show you the breakdown. This spreadsheet, you can see that 29 out of 49, 59% I did short strangles. The other trade, if it's a big stock like a DocuSign, probably not Amazon, I really do that one. Baba, I did it on Baba. I'll do a strangle, but I'll go out and I'll buy wings $20 out. So they're not really iron condors, but I call them an iron condor. It's a synthetic strangle because we put the wings on to define the risk. So I did 9 of those, 5 iron condors. That's 14. And so that's 43 out of 49. I usually do more double ratios. We talked about that in the room last week than this time, but that gives you an example or a picture of what I like to do on earnings trades. So let's, I think that's the stuff that I wanted to show you. I can, this is the platform that I primarily use for the trades in the room. I also use Thinkorswim. And I thought, well, maybe I'll find a quick trade for you today. I was looking, you can see here, Baba's got a high implied volatility rag. It got whacked last week. So what I think I'm going to do, this is the way I would approach this trade. I would probably start out saying, okay, let's look at a 1 standard deviation strangle. That's selling about the 17 delta. And I really don't know if I want to do Baba undefined risk. It's, that could really peel your face. So I'll say, okay, why don't we do an iron condor? Do a $5 wide iron condor. A third of that is, of course, $1.67. So I look at that and I say, oh, okay, I can only get $1.15. Some people will go ahead and do that trade. Like I told you early on in the presentation, I'm really consistent on I want to keep the probabilities about the same. So now I'll take a look at Baba and I'll say, okay, it was way up here and it's coming way down. I said, it looks to me like it's kind of rolled over. So I'll start maybe squeezing, maybe I'll go down a little closer on the top. And now I'm to $1.41. Do I want to, and I go up here. So now I'm short the 21 delta here and the 18 delta here. Now I'm at $1.57. I'm not going to do that. It still doesn't meet my criteria. So I'm going to go down a little bit closer and see if I can. That's $1.58, and that's at the 22 delta. And then now I'll make a decision. Do I want to go here, or do I want to go a little tighter on the put side? My inclination right now, the way this is sold off, I'll probably go a little tighter on the put side, maybe. So that's probably the trade I'll do for tomorrow, and that's how I would approach it. That takes longer than normally because I'm dealing with 4 legs, but $1.81. Because if I go further away, I'm only getting $1.55. I want to make sure I get $1.70. So that the other one I wanted to show you was GDXJ. I trade this every cycle. I got an exit to buy it back for $1, and I sold it for 209. So we're going to make a little over $1 on that one. I'm going to do a February. The implied volatility rank is too low, really, for a strangle, but I trade this one every cycle. So this kind of violates my criteria, and I'll probably come in and sell a 20 delta strangle on this thing. The problem with GDXJ right now, I'd have to sell the 60 or the 65. I would probably, unfortunately, opt for the 65. So that's probably the trade I would do. So let me see. I appreciate the questions. I hope I didn't bore you to tears.